Are you near retirement or already in it and wondering how the new tax bill might shake up your plans? You're not alone. For millions of Americans, every tweak to the tax code feels like it could tip the scales, especially when you're living on a fixed income or planning your exit from a business you've built your whole life. This video breaks down the proposed provisions in the latest tax legislation that directly impacts retirees and pre-retirees. We're going to keep it simple, practical, and focus on what really matters. How these changes could affect your taxes, your legacy, and your ability to retire. Keep in mind, at this time, the legislation is only approved by the House, meaning it still needs to be approved by the Senate, and I think it's safe to assume that there will still be a whole bunch of back and forth before anything is finalized. I'll also say there are some things proposed in the bill that I think are great and some that are not. I'm not here to pick sides and talk politics, but only to help you sift through all of the noise and make sense of how these changes could impact you. Before we start, I'm Rob Bacharach, and this channel is dedicated to helping you proactively make better decisions with your money. Let's get into it. First up, the new bill proposes to extend the lower income tax rates from the 2017 Tax Cuts and Jobs Act. Originally set to expire at the end of this year, 2025, these lower brackets could now become permanent. You can see here where tax rates are currently and will be starting in 2026 if this provision is not approved. For retirees drawing from IRAs, pensions, or investment income, this could mean thousands in tax savings every year, but only if the bill passes as written. That being said, there's a lot of talk about the budget deficit, and this is a real concern. While I'm all for lower taxes, this means the government will have to generate more revenue from somewhere else to make up the difference. Where this might come from, we don't know. If you're concerned about leaving a legacy, this one's for you. Currently, the estate tax exemption is at $13.99 million per person and is set to sunset in half back to the pre-2017 numbers at the end of this year, 2025. The new proposal aims to extend the current rules and increase the estate tax limits to $15 million per person. That means fewer families getting hit with estate taxes, at least for now. But don't get too comfortable. This could change with any new administration, just like any of the bills that we're going to discuss today. If this provision does not pass, the estate tax limit will sunset back to pre-2017 levels adjusted for inflation. What that means is it would bring the estate tax limit down to around $7 million. Now, I know $7 million might sound like a lot to some people, but those of you with a few $1 million in retirement savings or even $1 million getting ready for retirement might be very surprised by what your future could look like. To show you what I mean, here's a quick chart of a couple in their mid to late 50s with a little less than $2 million in investments as it stands today. With average rates of return and average spending, you can see how this money could compound over a lifetime. If their estate went over the exemption amount, based on the rules today, they could end up paying about 40% tax on every dollar that they go over. What that means is that if they were over $1 million over the estate tax limit, their estate would end up owing $400,000 in estate taxes. Now, this might seem like a long way away. Maybe you've never imagined having that much money, but this is the power of compounding interest, smart tax planning, and managing expenses for a couple who places a priority on passing wealth to the next generation. So, whether you think you're in the clear or not, estate planning not only matters, but it could have a massive impact on the amount of money that you actually get to pass to the next generation. Let's talk about a new proposed deduction specifically for people over age 65, or what they're referring to as seniors. If you're over the age of 65 and in or near retirement, this could have a real impact on how you plan your income over the next few years. This proposal is part of what's called the Bonus Tax Relief for American Seniors Act. If it passes, it would allow for up to a $4,000 deduction per filer over age 65, but only if your income is below certain thresholds. To qualify for the deduction, your modified adjusted gross income must be below $75,000 filing single or $150,000 married filing jointly. This deduction would only apply to tax years 2025 through 2028. Now, this sounds pretty good. That being said, during the campaign, there was a lot of talk about no taxes on Social Security. I think that this provision could be a way of delivering on that promise from Trump's campaign without actually changing Social Security. And I think this is the case because someone realized along the way that the administration couldn't just go ahead and change the rules about Social Security. They've been that way for a long time. The reason for this is that under the Senate's Byrd rule, any changes to Social Security benefits or structure have to go through the normal legislative process. They can't be done through the Budget Reconciliation Act, which is how the tax bills are done, how this new tax bill is going to be or not be passed. But let's say that the bill does pass. Here's what your standard deduction could look like if you're a senior married filing jointly and both over the age of 65. The standard deduction is proposed to increase from $15,000 to $16,000 for individuals and from $30,000 to $32,000 for married couples filing jointly. There's already enhanced senior deduction of $2,000 for an individual or $1,600 per person for those married filing jointly over age 65. So, an extra $3,200 for a married couple filing jointly. This bill is proposing another $4,000 deduction per person, meaning a married couple filing jointly could qualify for an extra $8,000 on their standard deduction, bringing their total standard deduction to $32,000 plus $3,200 plus $8,000 for a total of $43,200 standard deduction. To me, this certainly sounds like a better plan to help low to middle income seniors than the idea of eliminating taxes on Social Security. That didn't really make sense, and I discussed that a few months ago in a separate video, and I'll put the link in the description below if you're curious to learn more about the whole idea of eliminating taxes on Social Security and the impacts it could have. Now, assuming this bill does pass, I had a great question come in from a client just the other day. And the question was, should we cut back on Roth conversions in order to qualify for this deduction? Honestly, I wish I could give you a blanket answer, but I can't. It really depends on your long-term picture. What I can suggest is to keep this in mind. A new deduction, like this proposed standard deduction, is not a direct dollar-for-dollar reduction of your tax bill like a direct refund would be. It's more like a 20 or 25 cents on the dollar. So if your average effective tax rate came in at, let's say, 25%, then the new deduction is more like a 25 cents on the dollar reduction to your actual taxes. So if it's a $4,000 deduction, you might only save about $1,000 in taxes. And the final thing that I want to suggest with regards to this question, and this is something that I've talked about a lot in many other videos, and that's the idea that paying less taxes today is not always the best move. Typically, paying less taxes today will mean paying more taxes later. And finally, what is being removed from the current tax code that could impact your retirement? Most clean energy initiatives are taking a huge hit in this legislation. So, do you own an electric vehicle? Are you thinking about solar for your home? The bill proposes to terminate many clean energy tax credits. Some of those include the termination of previously owned clean vehicle credits, termination of new clean vehicle credits, termination of commercial clean vehicles, alternate fuel refueling property credits, home efficiency improvement credits, and many other clean energy initiatives that were put into place by the prior administration. If you've already invested in green energy, this could affect your bottom line. For example, I have a client thinking about a solar farm on a large piece of land that he owns. Depending how this bill comes to pass, it might not make sense to pursue that project. We'll just have to wait and see. Again, I'm not here to debate politics. I'm just sharing the information that is included inside of this new bill. I understand that will be some people very upset with the elimination of these clean energy tax credits. While this bill doesn't directly cut these programs, tax policy plays a huge role in the long-term funding of these programs. And there's been a lot of talk recently about the negative impacts that this new bill could have on health insurance premiums, Medicare, and other related premiums. So what's happening now will affect these programs' stability down the line. Getting into the debate and the details will take a separate video that I'll put out in the next couple of weeks. Ultimately, regardless of what happens, these changes could change your entire retirement landscape for better or worse. And while we're not certain about how the tax bill will play out, we are certain that trying to navigate these changes alone is risky. The tax code isn't built for simplicity, and missing a small detail could cost you thousands of dollars. If you're near or in retirement and feeling unsure how these changes might affect you, I'd love to help. I'll put a link in the description below where you can schedule a free consultation. Or if you have a question, send us an email. We'll walk through your situation and help you build a tax-smart retirement plan. I hope you enjoyed this video today. I look forward to seeing you next time. Please don't forget to subscribe to stay tuned for our latest content. Please don't forget to hit that subscribe button to stay tuned and get our latest updates to the evolving landscape of the new tax bills and other retirement planning strategies.